Hello and welcome to the Corporate Governance Network Workshop Webinar number 2. I hope that wherever you are, you're having a wonderful day. Today we have a very interesting program and we'll get underway now. So let's look at the key items that we're going to be discussing today. You're going to hear from Andrew Geddes, the former chairman of Green Cross Limited, who's going to talk to you about a positive culture is vital. Vital for directors and committee members to ensure has been implemented throughout the company or organisation. And then Paul Barnaby, the national representative for Plan Guru, will talk about good bookkeeping, helps businesses operate efficiently. Trevor Marchant, the managing director of Marchant Dallas, will talk about every business needs to make sales and directors should understand the selling process within your organisation. And Ross Contarino from the Australian Industry Group will talk about notifiable data breaches, a whole new concern for directors and committee members, because unfortunately a lot of organisations and companies are being subjected to cyber attack. And Ross is going to talk about cyber security. If you have any questions on the live broadcast, can you please type your question in and raise your hand using webinar jargon and send it through to me and I will answer it later in the webinar. Or if you're watching this as a recording, you can send us an email, peter@essbiztools.com.au, and we will reply to you, and we will also mention your question and the reply we have given in the next webinar workshop. And I'm going to do a corporate knowledge review of key matters affecting businesses and organisations. But the major news item to kick us off today is that at long last the Senate has passed the amendments to the Corporations Act to enable crowdsourced funding equity raising to be undertaken by private companies direct from the public without having to convert to an unlisted public company. This legislation is expected to be operational from mid-October. The legislation said it came into operation 28 days after royal assent, and we are estimating that that will mean the operational dates around the 15th of October. Crowdsourced funding equity raising applies to companies with group turnovers or group gross asset values under $25 million. $25 million is the magical figure in both calculations. A crowdsourced funding company can raise up to $5 million every 12 months from the public. This is a significant advantage that these types of companies are going to have. But companies will need to prepare other documentation to be submitted with the key document, which is known as the crowdsourced funding offer document. So some of the other documentation is mentioned on the screen at present. Business plan, budgets and cash flow forecasts for at least 3 years, company valuation, share price determination, and all that leads into the crowdsourced funding offer document. Company directors will require an understanding of how crowdsourced funding intermediaries work. There are 9 intermediary companies that have been appointed by the Australian Security Investment Commission, and they act as the gatekeepers for this legislation. Retail investors, that's anyone who is not a sophisticated investor, and a sophisticated investor is basically someone with a net worth of at least $2.5 million, or who earned a taxable income of $250,000 in each of the last 2 years, and has an accountant's certificate confirming that they meet the requirements to be classified as a sophisticated investor. So for everyone else, we're retail investors, can only invest up to $10,000 per company per annum. So if you want to invest $100,000, you can do so as long as it's with 10 separate companies in that 12 months. There's going to be many company directors who are going to be very happy about this change to the legislation, because it will enable a company to raise capital if you've got a good story, got a good idea, that can then be utilized to fund that ongoing development for the business without having to borrow money or try to borrow money. Is probably more an appropriate comment in the current environment. Now, most directors are going to need advice from accountants who are offering a specialised service relative to crowdsourced funding equity raising companies. If your accountant is a subscriber to ESS BIZTOOLS, and we have got accountants all over Australia utilising our products, then they will have the full product package for crowdsourced funding, which will assist them to be able to guide you through this process. We are presenting a special webinar for company directors and small medium enterprises on the crowdsourced funding legislation as it applies to private companies on Wednesday, 26th of September at 12:30 p.m. AEST. To register, please go to www.esssmallbusiness.com.au, and on top of the home page you'll notice a heading Webinars. Click onto Webinars and then register for this webinar, and then all you have to do is to log on at about 12:25 on the set date, which is once again the 26th of September. And by then we will have updated all of our material on crowdsourced funding, because we already had a package on crowdsourced funding which related to unlisted public companies. All that is now changed, and by then we will have the updated material, and we can give you a full run through, and we will have a summary of the products that will be available via ESS Small Business for company directors to subscribe for, if you wish, on matters relative to crowdsourced funding. Okay, the next item I want to move to today is corporate structure. We had the first component of corporate structures, which was the orthodox company structure, in webinar number 1. This one is looking at the role as to what happens when there is a mentor involved. It's quite common. I do a fair bit of mentoring work with boards of directors. So a mentor sits on the side. He or she is not a member of the board of directors. So just to recap, the shareholders have appointed the board of directors, but then the board of directors can appoint a mentor if they wish. A number of mentor appointments come via a government grant program, but the board might resolve itself that it needs a mentor, and the mentor might be engaged for 6 months, 12 months to look at what's happening, perhaps reorganise the board of directors, try to allocate some specific duties for the directors, and probably talk to the chair about what's going on in the company, what changes need to be made, and then talk to the individual directors. So at the end of the day, all the mentor is doing is giving advice to the directors. The final decisions, though, are still made by the directors. The chair and the directors make the decisions. The mentor definitely doesn't make the decisions, but the mentor can give advice to the directors. Just a reminder that you do have in your members area a action plan list. It's been prepared with each item in the agenda highlighted. You can make your notes as to items that may have to be attended to within your own company or organisation, or items that you are going to adopt as part of your personal plan to improve your knowledge of a range of matters relative to your company or organisation. I now want to move on to item 4, Directors Training. Directors Training is an ongoing task. As long as you are a director of a company, I think you should be keeping yourself abreast of what's happening in the law and within court cases. So you need to be reading the media and understanding what is happening in the wider Business Act areas, because all this can ultimately affect the way decisions are made that will affect companies. It's not quite the same effect on organisations, but obviously court decisions can also filter down to organisations. So for company directors, you need to have some familiarity with the Small Company Guide, which is referred to as Part 1.5 within the Corporations Act. You can go onto the internet, type in Corporations Act, and then type in Small Company Guide, and you will have the guide appear on your screen. Directors should be familiar with that guide because that's the key law that you need to abide by. The other key bits of legislation that directors need to be aware of include the Workplace Health and Safety Code, and that also applies to committee members of organisations, and the same thing applies to Fair Work Australia. You need to be able to read their material, read some of the articles. Jordan Lowry went through both of these items in webinar number 1, and Jordan will be joining us again for webinar number 3. So if you have any questions relative to Workplace Health and Safety Code or Fair Work Australia, please send them through to me, and I'll make sure that Jordan sees them before the recording of his presentation is made so that he can comment on them. And the other big area, in fact the elephant in the room, is always the Taxation Act. Directors need to be particularly aware of the Taxation Act because there are some sections of it that if the company has not complied with, directors can be personally liable to the Taxation Office. So you need to make sure that you're familiar with these items. I think the other things that directors should be looking at, in particular new directors, is if your company is operating in a particular industry, what legal matters apply to that industry. And this happens in lots of industries. There's various acts of parliament that have been introduced. It might be to deem some control over waste management or some other aspect of the business operations. It might be a special license to harvest trees, or might be a fishing license. Could be a range of matters, but directors then need to be familiar with that legislation. Directors also should familiarise yourselves, and so should committee members, with the mode of operations. What's this company or organisation do? Where's it operate? Is it a manufacturer? If so, where's the manufacturing facilities? If products are being manufactured overseas, has realistic inquiries been made to make sure that your company is not buying products from organisations that have resorted to child labour, for argument's sake? And will your inquiries satisfy the pub test? Now, will the general public accept that you have made some legitimate inquiries as to what's happening in that overseas country? Directors need to understand the basis on which the companies or organisations' accounting system has been put together. Is there a proper system? Is there accountability? Has the various components of the system been allocated to various team members to be responsible for? And does the company or organisation have a business plan? If not, you should be making sure that this is discussed at your next board or committee meeting, and that a business plan is prepared for your organisation, and then you utilise the business plan at each meeting to monitor how you're actually performing against the plan that was set some time ago. Let's now move on to directors' mentoring. Now, some of these items in the program that I've prepared, we're going to come back to the same headings on a number of the webinar workshops, but we hopefully are not going to repeat any matters that we've already discussed. So you might see directors mentoring in future webinars, but we'll be moving on. We've got a complete list on a spreadsheet of when the various items are going to be discussed. So we wanted to spread comments about particular items over a period of time, because we believe that will help you reflect on how you're going to implement some of these items within your organisation. If you're a new director to a board, no matter how experienced you are, I think you need to have some cups of coffee or tea or a glass of wine with the chair of that company or organisation that you're now involved with, at least in the first few months of your appointment, so that you can familiarise yourself with some of the matters that have been going on in this company or organisation. And a lot of that will do to the corporate history of some of the matters that might currently be being discussed at the board or committee table. It always helps you to have some background, some knowledge as to why certain decisions have been made in the past. However, let me stress to you that this should in no way bind you to an historical decision. I don't think that's a good idea. You need to know what the historical decision was and why it was made, but that doesn't mean that if in 2018-19 it needs to be updated or changed or thrown out, that doesn't occur. Directors and committee members are there to act now, and you're not bound to decisions that were made 5, 10, 20 years ago. Sure, you should explore them, and before changing them, you should understand why that decision was made and what might be the ramifications if you remove that decision from your company or organisation's thinking. But you are required to be making honest decisions based on the current facts, not some historical decision. And I think that's very important. If you got any questions on that, you might send me a note now or a little bit later on, or send me an email and I'll respond later. Let's move on now to directors' leadership skills that needs to be developed. Now, I've used an article, and I'm quite happy to place this article into the members area. In fact, I will make a note of that now, otherwise with my memory I will forget. And the article was really looking at leadership and management, but it brought out a lot of interesting matters. It's based on the leadership material that has been written for us by Peter McDougall from Leadership Academy. Good leadership is required in companies, businesses and organisations. Well, I think that's a given, but it's always good to put it on the screen, I think. But it's also very important that there's some distinguishing features between what's management's responsibility and what is leadership. Management is essentially about the establishment of organisations, structures, processes and procedures, looking at things like staffing, management of costs, implementation of ideas, team training. This is normally done after the board of directors have signed off on the broad policies of the company or organisation, and the board or committee has appointed a general manager, CEO, managing director, whatever that person's title is. And that person is primarily responsible for the day-to-day operations. But the directors need to be making inquiries to satisfy yourself that everything is happening that should be happening. Leadership is about creating the environment in which people work willingly together to achieve commonly agreed ideas and goals. Now, most people are not born leaders. Most need to develop their leadership skills by training and real-life experience. So the key components of leadership is centred on an understanding of teams and teamwork, how teams work together, coaching and counselling of members of the team, solving problems, morale of the team for which the leader is responsible, developing relationships so the leader has an understanding of the challenges that a team member is facing, motivation of the team, encouraging the development of ideas, and then selling those ideas and strategies to the team. And it could be the wider team in a company or organisation as well, couldn't it? Trust and delegation. I'm sure you all realise you cannot do it all yourself. The leader's role is to inspire the team to go forth and implement. This is delegation. They can't try and do it all themselves. So we'll have more to say about this whole area of directors' leadership and the key components of leadership in some future webinar workshops. Now I want to talk about team awareness. Directors need to ensure that you are showing sufficient interest in what's happening within the business so that you have a working knowledge of what team members do. That doesn't mean that you're going to know every single team member's job in detail, but it does mean that directors need to do some walkarounds at times, go to the factory, go to the loading dock, walk around the office, observe what people are doing, say good day. An understanding of the team structure within the company or organisation, corporate structure that operates in the business. What efforts have been made to attract and retain outstanding team members? Directors should be very concerned at high staff turnover figures and should be making some inquiries of senior management. What attempts were made to retain these people? I think it's important that directors have an understanding of how the media and social media are utilised by the team to promote the company or organisation's point of view. What training has been given to the team as to how they might react in an emergency situation? Whether it's a car accident, whether it's an armed robbery, whether it's this great disaster that we have at present with people interfering with strawberries and other food products? How would you handle that if that was your business? Or if, unfortunately, something similar may have happened in your business? You mightn't have strawberries that someone can put needles into them. But how would your team react if you had one of these problems that's come completely out of left field? Companies and organisations need to be thinking about some of these issues. I don't think 2 weeks ago I would have even thought about talking about needles being inserted into strawberries and asking you how you might react to that. But it's now a big issue, isn't it? And some overseas countries are now refusing to accept our food products. I don't know what drives people to this level of insanity to do these things, but it has happened. And the level of training and professional development that's been introduced to the company. So that's the end of this section on team awareness. I now want to introduce you to Andrew Geddes. I've known Andrew Geddes since 1984, and it's been an interesting journey. When I first met Andrew Geddes, he was a lecturer at the University of New England at Armidale, and he was the founder of Financial Management Research Centre. One of his graduate students that he'd mentored went on to become the managing director of a company known as Green Cross Limited, which is a veterinary surgery business together with an animal products supplier, branches all over Australia. And one of the key things Andrew is going to share with you today is the journey that he took with Dr. Glenn Richards, who was a veterinary surgeon in Townsville in a small practice, and guided him right through to developing a company that was listed in the ASX Top 200. And for 11 years, Andrew Geddes was the chair of that public company. He basically only retired because the stock exchange frowns on the same person being the director, or indeed being the chairman of directors for more than 10 years. They like to see these positions rotating. So we're now going to give you the opportunity of listening to a recording produced by Andrew Geddes.
Okay, well, good morning, everyone. Andrew Geddes here. Peter has asked me to join him for 3 separate webinars to tell the story about my involvement with Green Cross Limited over 30 years, as you can see, from a single veterinary clinic to a top 200 ASX listed company. The 3 webinars, there's today's one, which will look at the journey that we took and the tools that we used. On December the 5th, I'm going to look at it in a lot more detail in terms of how we really drove growth. We had to do quite a bit of work on our internal management system to be able to move from about 30 vet clinics to over 150 over a 10-year period. And then finally, June next year, one of the tools I created in my involvement with Green Cross was a leadership improvement plan for each of the senior executives. We'll walk our way through that as well. So there's the 3 topics coming up over the next 9 months. So the Green Cross story, we started out when I first met Dr. Glenn Richards. He was an undergraduate at the University of Sydney, and I ran a program for the final year students of both Queensland and New South Wales universities. Oops, let me go back again. Then the stages of growth we went through, we were a cooperative for a while. We got ready to list in the mid-2005 to 6. Then the early growth years when we built a strong senior management team. merging with Petbarn in 2014 and then refreshing the board in 2017 when I retired from the board after 13 years on the board and probably about 25 years involved with Glenn. So they're the stages that we went through that we're going to address today. So the initial meeting, as I said, was a graduate workshop sponsored by the Universities of Queensland and the Sydney Uni's veterinary faculties. It was a weekend program. At the time, we were running business management and development programs for all sorts of professionals, accountants, engineers and veterinarians and others. So we spent a weekend putting the final year students through the program. We had a barbecue and a few beers that night, and I spent quite a bit of time getting to know Glenn, and we struck up a friendship. Several years after that, Glenn purchased a practice in Townsville, talked to me about purchase of that business, and he opened some other clinics and a retail pet store, and so began his journey. At that stage, we got together with a number of other veterinarians who had multiple clinics. A group in Brisbane, a group in Sydney, a group in Melbourne, plus Glenn from Townsville, and we focused on really skilling up our veterinary nurses, practice managers, and then we looked at the standards of care we used in the clinics and asked the veterinarians to help us develop some higher standards of care and to drive this across all of the clinics. That led to using the name Green Cross and working together with brand development and marketing. And the real winner financially was when we went to the wholesalers and said, if we put all of our purchases through you as a group, what can you do for us? And that put a few percentage points on the bottom line of every clinic. One of the things we did do was get together regularly and share our business experiences, usually over dinner and a few fine wines, and that helped us create rapport and develop the relationship between all our members. At that stage, we were approached by another group of veterinary practices that had agreed to form themselves into a group to see if they could get together and list on the stock exchange. Their group and our group looked like about 60 practices. We then had to go through a search for non-executive board members. So we invited one of the joint CEOs of Petbarn veterinary retailers to join our board. Dr. Glenn Richards was already serving on their board. We then sought accountants, lawyers and underwriters for the list, recruited some senior executives, and with our full of enthusiasm and hope, we listed in 2006. We were a micro-cap list, probably far too small. I think we should have been 2 to 3 times the size, but that's one of the lessons from hindsight. The resulting situation was that no institutional investors invested in us because we were too small, and we really had to grow the company. We were able to raise finance from a group of banks, and we then looked at our senior management group and realised we had to purchase and bring in at least double the number of veterinary practices that we had within a couple of years. And that meant we had to build a senior management team who were really focused on acquiring veterinary practices, doing the due diligence, and then assimilating them into the group. We realised that we had to create a strong culture, so the senior management team were asked to craft some core values, which they did, and that, I think, was the reason for our success, because we knew who we needed and what we were trying to achieve and what was acceptable and not acceptable in terms of attitude and behaviour. So in looking at this, I'll just share with you the core values that the senior management team created. As you can see, our purpose was to share our love and passion for animals through the pursuit of veterinary excellence hence the importance of the standards of care. The senior management group came up with some core values structured around teamwork, and notice the use of the word we will. We will create an environment that promotes collaboration and harmony among our teams. We will demonstrate a caring attitude that respects and values our clients' and teammates' beliefs and opinions. Then in integrity, we will always be authentic, we will always be honest. In terms of professionalism, we will be fair and ethical and deliver confident, competent and conscientious care for clients, patients and teammates. Now that's the unique nature of veterinary practice, in that you have customers, then you've got the animals who are the patients, and you've got your colleagues. So you're really catering to a group of three. The team thought excellence, doing our best and delivering uncompromising standards of care would set us apart. And we looked at having innovation in the way we went about doing business, so that we could create a senior management group that ran a head office that provided great services to the veterinary practices that we purchased and then assimilated. Now, going back to the core values, we then used them by building a story around each core value based on what a team member had done. That was built into newsletters. We used it in recruiting and selection by asking questions around behaviour related to those values. We used it in induction and orientation sessions and in performance appraisal, and in giving feedback to individuals, thanking them for doing the right thing and or pointing out when they didn't and asking them to adjust their behaviour. So in the early years, the focus was to create a positive culture around those values, to grow a senior management team that enabled us to handle growth. Then, having hit those objectives, we really built the group over 5 years. We probably got there in half the time we thought we were going to need. And at that stage, we had been discussing the possibility of merging with Petbarn in order to create a vertically integrated offering to pet owners, in terms of they could obtain veterinary care and quality food and products for the care of their pets. At the time, the humanisation of pets is where a pet becomes a family member, sleeps on the bed with their owners in a lot of cases. So the whole merger was based on creating a business that would be convenient for our clients. It allowed the private equity investors in Petbarn to exit. We added 2 new board members to the board with merchant banking and retail experience. And at the same time, I stepped down as chairman and asked one of the experienced directors that we had, who had been a managing director of a large financial organisation, to step into the chair's role. He was more acceptable to the institutional investors we were trying to attract, and we were able to do so when we did merge with Petbarn through a capital raising. The commercial reasons were to locate clinics within the big retail box stores so that it was more convenient for clients, and that certainly drove the business into its next stage. Then in 2017, my term as a non-executive director was up, and I didn't seek re-election. I'd been there for more than 10 years, and the ASX governance suggests directors shouldn't serve beyond that. We also were looking to get some more women serving on our board. The proxy advisory firms acting for institutional investors who assess the annual reports and the remuneration reports would not recommend those reports to institutional investors unless you adhered with the ASX governance suggestions. So that's another example of how the governance standards are influencing decisions on boards in Australia, and something that you need to be aware of over time. The lessons from this journey were listings expensive. The initial listing about $500,000, and the ongoing costs in terms of accountants' reports, audits done annually, the tours you have to put on in terms of communicating with institutional investors. I think we were too small to list and should have waited, but that's a lesson that we now have on board. I reckon 100 million turnover at least, and possibly 10 to 20% EBIT. Otherwise, those costs really are quite large. The managing director or CEO needs to build a senior management team based on trust, so that there can be rigorous debate and analysis of both strategies and risks. It's very important to manage a high growth company that's moved from a number of smaller private businesses, small businesses in fact, into a company that's really served by a senior management team providing services in terms of marketing and accounting and recruitment, standards of care, negotiations with suppliers in terms of purchasing. You've got to be able to onboard and integrate and look after the individual clinics that you acquire to service that type of growth. And the board needs to support this by serving all of the stakeholders, the senior management group, the individual practitioners in the clinics, and local communities, suppliers. I believe that the board supported the senior management group who were able to achieve this growth and bed those companies in. So that's the journey that we went through over 30 years. We moved from 30 clinics to initial listing of 60 odd clinics up to over 150 and over 250 retail stores, and the growth continues as we speak. So in the webinars that are coming up, I will build on that by going into more detail about the way we built the senior management team, and then the way we develop leadership skills within it in the third webinar that occurs in June 2019. So thank you, Peter. Perhaps I can turn it back to you at this stage.
Thank you very much, Andrew. Andrew Geddes made some interesting comments there, didn't he, about skilling up in an organisation, making sure the standards of care or standards of service are implemented across the organisation. The development of core values, I find that very interesting, looking at teamwork, integrity, level of professionalism, pursuit of excellence, innovation being a very important subject. And then they created stories about how people actually implemented those core values. They gave a lot of importance to the induction process for any new team member. And then we heard some of the issues for public companies, terms for directors' appointments for non-executive directors, the Australian Stock Exchange governance requirements, the great influence that proxy advisors can have in various issues, and some of the profitability targeting that obviously goes on or does go on. Andrew mentioned targeting a 20% EBIT, that's earnings before interest and tax. So the key message for the people who are participating in this corporate governance workshop is, which of these key items also applies to you? You have to remember that 30 years ago, Green Cross was a small one veterinary surgery practice in Townsville. I live in Townsville. My daughter used to take her dog to that centre. So I can remember the very beginning of that business, and over the years I've observed various aspects of its journey. If you have any questions that you would like to ask Andrew Geddes before his next presentation, which is in December, please send me an email and I'll forward that on to Andrew, and he can then cover that in his response. Membership of management committees. So we're just going to go into the management committees. Under the legislation that applies, members of management committees must be adults, so that's over 18 years of age. And the Associations Act indicates that there must be a minimum of 3 members on a management committee. That doesn't mean that that's all there should be. It's the minimum figure. And in fact, many organisations have larger numbers than 3 on their management committee. Eligibility for election to a management committee, I've summarised that on the screen there at present. A person can't be elected if they've been convicted of those offences and the rehabilitation period is not yet concluded. Normally, management committee members are elected at the annual general meeting or a general meeting, but it has to be in accordance with the rules. And members of management committees normally hold office and retire as prescribed by the organisation's own rules. Public liability insurance is a big issue for associations. The management committee must at least annually consider whether there is a need for the association to take out public liability insurance, and a report on this decision should be submitted at the organisation's annual general meeting. But the legislation does specify in some instances public liability insurance must be taken out if the association owns land or is the lessee of land or is a trustee of trust land held under a Land Act. And the Land Act mentioned there is the Queensland Land Act, but that would apply in every other state with their own particular Land Act. Appointment of committee members. The Constitution is the important document, and just as we discussed when we were looking at companies a little bit earlier, that directors should be reading the small business sections within the Corporations Act, committee members of organisations should have read and be very familiar with what's in the Constitution. So you would understand how committee members get appointed. But in many constitutions, a general meeting of the organisation can appoint a committee member, and most organisations have a clause that in the case of a casual vacancy, the committee can appoint a replacement who would hold office until either the next general meeting or at the latest the next annual general meeting. Committee members should always sign an acceptance of appointment letter. It formalises, it commits that they have agreed on a certain date to be appointed to the committee, and the secretary should ensure that the appointment is recorded in the minutes of the committee meeting and that the acceptance of appointment letter is appropriately filed, and that the appointment of a new committee member is recorded in the register of committee members for your organisation. And when a committee member resigns, that resignation should be recorded in that register. Transition of property. This goes back to when an association is incorporated under the Associations Incorporations Act. Property can then be transferred into the name of the incorporated association. Let's look at some of the powers of an incorporated association. One of the real benefits of this legislation right around Australia is that the incorporated association has the power of an individual. So the association can enter into contracts, can acquire and dispose of property, make charges for services, and do anything else that's necessary for carrying out its duties. So an incorporated association does not need to appoint trustees. 30 years ago, nearly every organisation had to have trustees, especially if you owned assets or entered into agreements with banks or governments. You had to have trustees. That's not necessary if your organisation is incorporated. Liability of members. A secretary, member of a management committee or member of an incorporated association is not personally liable except as provided in the rules of the incorporated association. So if you, in your constitution, it indicates on some basis that a member of the committee or the secretary could be liable for something, you mightn't get too many people wanting to be on your committee or be the secretary then, of course, but that's where it would be defined. Normally the only liability is if a committee member or the secretary owes money that has been a debt created through the normal trading of the activity, nothing to do with a member's liability as such. Let's look at some of the risk management strategies that relate to both organisations and companies. And this follows on from webinar number 1, where we started to explore risk. Risk is a big problem area for all sorts of businesses. Understanding of potential exposure from a contract. Very important that someone's given consideration to this. Normally the management team, but they should be reporting to the board. Understanding what your risks are under the Workplace Health and Safety codes and Human Resources Fair Work Australia requirements. Very important that there's been some questions asked. And if as a director or a committee member, you're unsure of what your organisation's exposure is, please ask at a committee or board meeting and get an explanation. And if need be, get an expert in. Might be an insurance broker, might be someone like Jordan Lowry to talk about your potential exposure under Workplace Health and Safety or Fair Work Australia requirements. Another matter that we're going to do some talking about over this period is intellectual property protection. This is an asset that can be shown on organisations, companies' balance sheets, but a lot of people forget about it. So the key to protecting intellectual property, if your company or organisation is undertaking any research and development, document it so that it's known who's been working on it and what's been done. If you have contractors working for your company or organisation and you are developing something that might be of value, you need to have an agreement signed by the contractor assigning the intellectual property to your company or organisation. If you don't, that contractor owns that segment of the knowledge that's been developed. You might say, well, we're paying him or her. Doesn't matter. That's the law. So you need to talk to your lawyers about that if you are, in fact, developing an intellectual property asset. You may need to talk to a patent attorney about looking at whether it is desirable to proceed with a patent application. So directors should be asking that question. What are the research and development programs we've got underway? How are we protecting the intellectual property, especially if we are engaging contractors? Have we got a report from a patent attorney on the probability of us being able to patent this particular idea? What's it going to cost? What's the timelines? There should also be confidentiality agreements for anyone else that might have been involved in this overall project. And one of the other big assets that many companies and organisations can have is trade secrets. We've all heard of the Coca-Cola formula. Well, it's a trade secret, and it's stood the test of time for over 100 years. There are a lot of trade secrets in business, and some organisations have got them. They need to be documented. They need to be locked away somewhere, but they can be a very valuable asset. And the other asset is copyright. If you're writing material, producing articles, producing instruction manuals, it's a good idea to always put on the copyright notice somewhere on that page so that you're telling people that you have ownership to that. We're now going to introduce you to our second keynote speaker today. That handsome gentleman on the screen is a close friend of mine, Ross Contarino. Ross is the Business Facilitator Supply Chain Coordinator for the Australian Industry Group. AI Group have contracts with the federal government, primarily Oz Industry, to deliver a number of federal government programs. They are a major industry organisation in Australia. They've been going for about 135 years. Ross hasn't been with them that long, but they've had a long history in Australia. And what Ross is going to talk to you today about is something that's really come out of left field in the last couple of years, and that is cyber security issues and the new regulations that now apply for notifiable data breaches, which have applied since March this year. So we're now going to call upon Ross.
Good afternoon, Ross Contarino here, Business Facilitator with the Supply Chain team with the Australian Industry Group and the Federal Government's Department of Industry, Innovation and Science. This afternoon I'm giving a short webinar as part of the process that Peter Towers is doing with his network, corporate governance network across businesses. And I thought today I'd talk a little bit about some of the issues surrounding cybersecurity, as it's becoming quite a big issue of late. So as I said, I work for the Australian Industry Group. They've been around now for 140 years in a couple of different names, but their main purpose is to provide industrial relations support for their member base. They do that through their workplace lawyers and teams in a dedicated telephone centre where people can ring in and get issues resolved very quickly. So Australian Industry Group have been doing that role for a long time across Australia, and they also are quite a great advocate for business in Australia, and our CEO and different people within our organisation are often seen lobbying governments of all different persuasions and states and federal and whatnot about issues about making business easier for Australian small businesses. The department itself, Department of Industry, Innovation and Science, is all about, its main mantra is about growing Australian businesses, and therefore this fits in quite comfortably with the work that Peter's doing with the network of businesses he's trying to work with across North Queensland. I said this afternoon I would talk about cybersecurity because it is an emerging issue that's becoming quite a concern, and many of our customers have been have notified us recently that they've had breaches, or they've had ransomware attacks, or they've had information stolen, they've had money taken out of different bank accounts and whatnot. So it is a huge issue. We're seeing that the entry to this entry to market for these hackers is a very simple thing. They need a telephone, a laptop and access to the internet, and they can do all sorts of havoc with businesses around the world. So making sure that you're as safe as you can possibly be is probably one of the biggest issues businesses need to confront over the next short period. The department itself has realised that and has put a lot of work into trying to see whether businesses can be better prepared for these sorts of attacks. A couple of examples of attacks which happened to some of our customers recently. One customer in the southeast corner of Queensland purchased some rather large robotic welding equipment and whatnot. Was very happy with the way that was working. It was saving them a lot of money. They were being able to, their productivity was right up. They then received an email that looked like it was from the manufacturer of the machine and said, if you'd like to download the 2018 operational manual, which they did. When they downloaded the file, it wasn't an operational manual, it was just a couple of photos of the machine, so they thought no more of it until the machine then started to malfunction. They thought the machine was broken and called the installers to come back and fix it, and the installers found that some viruses had been implanted into the machine and rendered it useless. So that was a fairly big cost for that business to be able to then cleanse all of their systems and start again. And businesses are seeing those sorts of attacks happening more and more. Every day people are talking to us about having money taken out of credit cards or different scams that are coming through. But probably the most sinister ones are the ones that we really don't realise, the ransomware attacks and the corporate cyber attacks that we really need to be across. The government has now put in certain legislation in place so that small businesses, if they're over a certain size, have to announce any attacks that have happened and register those with the government. There are serious fines for companies that fail to do that. So we recommend that any attacks that you get, you should register those with the government as soon as possible. So what is the government trying to do to alleviate these issues? Well, it's really about the security. It's just like how safe your house is and how good your locks and your fences and whatnot are. It's all about how you can do that with your business systems as well. To try to help with that process, we've developed a couple of tools. One of them is a self-assessment tool where businesses can simply log into the system, answer a series of questions about how their systems work and how their different securities work with PIN numbers and whatnot. So you work through a series of questions and then a report is generated, and it will highlight the areas where there could be weaknesses, and then businesses can then take that information and work out what's the best way of protecting their businesses. A more in-depth program is also available through our business advisors. So the business advisors that we have around Australia, they can come and use a more in-depth tool which will give a more fine look at your security and offer sort of more in-depth and individualised recommendations. So highly recommend that you go down that path. The self-assessment tool will shortly be available on our website, business.gov.au, and you simply search for cybersecurity. Unfortunately, it's not on the site as yet. There's still some testing being done, so it's not there, it's not available. But highly recommend that businesses go through this step. It will take you about 20 minutes, and it will give you some really good answers about what you can do with your business. If that's something you'd like to do now, please contact myself or Peter Towers, and we can send you a link so that you can jump in and do that assessment as soon as possible. If businesses are eligible to be part of the Entrepreneurs Program, which is the program for business growth that the department runs, our business advisors can then go forward and do the more in-depth process with you, and that obviously will be a far stronger and better solution for the security of your files and your finances and whatnot. So highly recommend that you go through either of those two processes. Have a look at the Entrepreneurs Program. As I said earlier, business.gov.au, and type in Entrepreneurs Program, and you can see all the different facets of the program there and how that can assist Australian businesses. The main program in that is called the Business Evaluation, and that's where our business advisors come and do a deep dive, look at your business and all the systems and your finances and whatnot, and give you some recommendations. And the recommendations will say, these are some areas that you're doing very well, and here's a few areas which maybe you could improve on. And then you can then download some of the grant funds to be able to work individually on those issues and try to get your business in a better position to take opportunities from the global markets. So I highly recommend that you have a look at the supply chain program as well. It's one that the business facilitators like myself run, and that's where we work with bigger, larger companies who then give us the lists and names of the companies that supply services to them, and we go through those companies and try to help them become better suppliers to those companies. So the Entrepreneur Program has a lot of different facets. One of the other ones is all around linking businesses that are trying to do some research and development with government agencies and universities and research agencies that can help them with that. And there are serious funds available to be able to undertake that research in-house in your own business. So please have a look at the Entrepreneurs Program and all the different facets. Contact Peter or myself, and we can give you some more in-depth knowledge of the programs and all the different assistance that's out there. But if you have any take-homes from today's message at all, please have a look at your cybersecurity, lock the gate, put another chain and padlock on it, and make sure that these insidious people don't come in and wreak havoc in your business and disrupt your business reputation. Thank you and good afternoon.
Thank you very much, Ross. And Ross had some interesting comments to make there about the unfortunate situation that's occurring in the marketplace with ransomware attacks and the ease with which some people are able to cause disruption to your business. And my apologies, you didn't have a screen for a while there. That was because I didn't follow my checklist. We've all got to follow checklists. Ross gave you some examples of some of the problems that people are having. You need to be very careful about emails coming into your organizations. They can contain viruses. Ross also mentioned the new legislation that's been introduced that applies to all businesses with turnovers over $3 million. You must report any cyber attacks, and a lot of businesses and organizations with turnovers under $3 million can be caught up in this reporting requirement process. And after all, that's for everyone's benefit. But that would be people who have got personal records of people. So it might be in the health industry, physiotherapy industry, all the allied health industries, and plenty of other businesses. Ross mentioned the eligibility for the Entrepreneurs Program. We'll place some material relative to the Entrepreneurs Program into the members area that you can have a look at. And we'll also include some information on the suppliers chain network, which is really where Ross spends a fair bit of his time, and the research and development linkages. And I think Ross's final summing up was very good. You need to lock the gate to stop these people getting access to your materials, your assets. Okay, so the next thing we're going to go to is balance sheets. Now, I'm going to get excited about this because my profession is an accountant. And I think it's very important that all company directors and committee members have an understanding of financial accounts. Does not necessarily mean you know how to produce them, but you do know how to read them and understand them. So last webinar, we looked at the profit and loss account and the various ratios that link to the profit and loss account. Today we've got you some material on balance sheets. Balance sheets are basically an historical record. So what we've started off here is and this one is a unit trust. You might remember the profit and loss example we had in webinar 1 was a trust. So we've now got the balance sheet for that trust. On the left-hand side, we have the comparison to the previous financial year's figures, and on the right-hand side, it's the current year. And we show the various components. That $1,000 is not out there for any particular reason. That should have been back in that column there. So don't look at that and say to yourselves, why is that being put out there? These are the current assets. Current assets basically mean any asset that could be converted into cash in the next 12 months if you wanted to do so. So we have some building society accounts and cash register floats. Obviously, they're both in cash. Same with the petty cash float, until it's spent, of course. Sundry debtors is amounts that were owed to this business by their customers. And in the normal course of business, you most definitely expect that all that money was going to be paid to you in the next 12 months. And stock on hand, $29,000 worth, you would be expecting that would at least be turned over during the next 12 months. So the total of the current assets, I'm going back too far, is $72,378. We then have to deduct the current liabilities. Current liabilities is a liability that in the normal course of business will be due for payment in the next 12 months. A bank overdraft is normally allocated to you by a bank on that basis. Some bank overdrafts just roll on from one year to the next, but banks can call them up basically at any time. The creditors is the amounts that are owed for sundry purchases, which in this case total $16,000. The bank loan, the current portion, you might remember we had a fair bit of discussion in webinar number 1 about the outcome of the Centro Properties case, which really centred on what the financial accounts disclosed as being a current liability on a very large loan that company had received. So we've stuck in here, we've got a lot smaller in this little trust, only $13,000. And then we've got the current portion of hire purchase commitments, and again, that should have been over in this column over here. And so the total current liabilities were shown as $55,664. And accountants then calculate the excess of current assets over current liabilities. If this was not a positive figure, that figure would normally be shown in brackets, or these days with computer packages preparing a lot of financial accounts, there might be a minus sign in front of the figure. You need to look very closely at financial accounts at times just to see that there's not a minus in front of a figure. Unfortunately, the minus signs tend to be rather small and they can be missed. And I've seen some very experienced people go off and start making decisions on the basis that a particular figure was a positive figure, and then to their embarrassment they realise later on, or more importantly, for their embarrassment, someone else right junior to them might have pointed out to them that in fact that was a minus figure, and will that make any difference, sir? Well, of course it does. So we then have fixed assets. Now these are the if you had land and buildings, this is where land and buildings would be shown, your fixtures and fittings, your plant and equipment, motor vehicles. And there's normally depreciation. So this is the amount of money that normally the tax officers allowed the company to start writing off against their profits over the useful life of an asset. And the tax commissioner makes pronouncements as to what various items can be written off at, and that's based on what the tax department believe the life expectancy of that asset will be. Your company or organisation can apply to the tax commissioner for a specific ruling on an asset that's been utilised in your business. This happens a lot in the mining industry, where vehicles are being placed into underground mines, rarely come to the service, getting worked 7/24. Their life expectancy is normally a lot less than what you would expect for a vehicle that was being used above ground, only being used for 8 to 10 hours a day on reasonably good roads. Goodwill is an amount that obviously this business paid to acquire the business at some stage in the past. It's a bit of a dead asset in that it can't be written off. It just sits there. that that's what you're paid to get into this business. And again, that 5693, which represents the non-allocated hire purchase charge, should have been under the $19,000. Hire purchase charges can be written off over the period of the hire purchase agreement. So there would normally be an amount each year that's been written off. This was obviously a new hire purchase agreement, and it would be written off over the period of the agreement. We then have long-term liabilities. So long-term liabilities are shown as the total of the debt less and we've already shown in current liabilities the amount to be paid this year. So back over here, we had the bank loan. The current portion is $13,000. And in the long-term liabilities, there's $26,000. So that appears that that's probably been treated correctly, which would satisfy the requirements outlined in the Centro Properties case. In the hire purchase agreement, we've shown $6,120 has been the debt payable in 12 months, and over 12 months we've got $12,240. So I suppose from that this was a 3-year agreement, and the hire purchase charges in effect will be getting written off over 3 years. So we total the long-term liabilities and we add them to the current liabilities, and we get a figure of $59,000. We've then got the beneficiaries accounts of Mr. Boggs and Mrs. Boggs. That's just the distribution of profits that have been made to them, and the same with the children who are beneficiaries. So the net effect is the trust has got an overall net worth of $20. That's very similar in trusts, that what happens all the time, because all the profits have to be distributed to beneficiaries who then pay their personal income tax on those profit distributions. So that's an overview of a balance sheet. It's very important that every item in a balance sheet has been supported. So for argument's sake, the amount shown for debtors should be supported by a debtors age analysis. Stock take should be supported by a stock take figure. And the location of those assets that the company has should be identified, so that as a director, when you're presented these accounts, you don't only get the nice P&L and balance sheet, but you get supplementary information. And one of the key items that you should be making sure you get is the verification of every item that's in that balance sheet. Prove it to me should be your opening comment to your Chief Financial Officer or accountant. We discussed meaning of current portion last month, and I think I've already given you that, and I once again referred to the Centro Properties case. And we talked about the meaning of non-current portion, so we won't have to spend too much time on that. There are various ratios which are described in the material. The first one is the current ratio. This is a ratio that is regularly calculated by bankers and lenders, and all it is the relationship between the current assets and the current liabilities. And this is one of the reasons why the lender in the Centro property case got so disturbed, because when they looked at the published financial accounts, the current ratio looked a lot better than what it would have if the correct amount of current liabilities had been shown. Some banks have rules that current ratios should be 1.5, even up to 2, but you'd have to ask your individual banker what they want. The calculation of the current assets less current liabilities is sometimes called working capital, and that's just how those calculations were done. There are some other ratios that people use, particularly bankers. This one here is the current assets less stock. So this is showing the calculation of that. Here's the current year's figure. So we got, we had current assets of 61,000. We took off the stock, so we had current assets less stock 34,000. The reasoning behind this is stock can take a while to sell, so if you really needed to get some money fairly quickly, this business could get $34,000. What are the liabilities? But we took out the bank overdraft because that's how this is done. And basically it's looking at what's the relationship between the current assets less stock and the current liabilities less the bank overdraft. Excuse me. Pardon me. And this is called the quick ratio at times. There's then a calculation of the debtors relationship. So what is the debtors balance as compared to the credit sales? It's one of the reasons when last time we talked, I indicated that we had dissected the credit sales, so it would facilitate some further calculations. Well, this showed that the relationship of debtors had dropped marginally from 18.9 to 17.1%. That's the percentage owed by debtors as a percentage of sales. You should always be getting that figure as low as you can, if possible. Debtors balance divided by daily sales, that's just the calculation there. We divide the credit sales by 365, and that determines a daily credit sales figure. Then we divide that figure into the debtors balance, and this tells you how many days the debtors have been outstanding. If this business was trying to trade on a 30-day basis, their debtors balances are over 100% higher than what they should be. And this highlights the necessity for directors to be continually looking at debtors days outstanding and the debtors balances and urging management to take more action to reduce them. A similar exercise can be prepared for creditors as creditors divided by credit purchases to see what the ratio is, and then to compare that to what negotiations you had with creditors' balances. Now, we're showing here 34.9 days. That looks fairly healthy to me, unless your terms of trade are 14 days. And if that's the case, your creditors could start taking action against you. But if you're trading on 30 days, 34.9 days is probably okay. It's a bit higher, but there's a lot of others a lot worse than that, I can assure you. A regular calculation that bankers want calculated if they're going to lend someone money is what was your profit before tax and interest divided by interest. So it's the number of times that the interest was covered by the profit. So in this exercise, you can see currently it's 3.83. In the previous year, it was 3.9. I think the bank would accept that's fairly healthy. So hopefully that gives you some idea of some of the key matters relative to balance sheets. If you have any questions, and I will just recheck again, I've got no questions. So if you have any questions, please either ask me today or send me an email. Key performance indicators. I think every company should be developing a set of key performance indicators, which means something to your business. It's no use adopting the key performance indicators of BHP for a small steel fabrication plant situated in your town. You need to develop your own. It's a good idea to look at the calculations that benchmarking.com.au prepare, because they've shown a lot of the key performance indicators for various industries, and we're going to be talking about benchmarking in more detail in the next webinar workshop. It's very important, though, that the managers and supervisors, the management team, understand what the key performance indicators for which they're responsible, and in fact have some direct input into what key performance indicators they need to be able to perform their job. These are the people there, they're the line managers. If they come up with a particular figure that they'd like to know every day, I think management and the accounting people should make sure that they can get it. But also they need to be educated in the KPIs that management or the accounting team are saying that they've got to prepare. So things such as gross profit percentage, labour to sales percentage. We talked about those in the previous webinar when we examined some of these figures relative to a profit and loss account. So if you don't know anything about the key performance indicators that apply in your company or organisation, why not start asking some questions? What key performance indicators are our management team using? The next item I want to talk to you is understanding budgets and cash flow forecasts. The first thing that normally happens is some market research is done and then a market plan is prepared. Now the market research might be done by an internal person and it might look at competitors, new products being sold by your competitors, someone that looks like they're going to come to town, changes in market preference, perhaps changes in roads can have an effect on the market in a particular business. And then it might be developed into a marketing plan, or you may get an external consultant to prepare that market research for you. And then you would look at a range of budgets that could be broken into some of these categories. And we're about to hear from a budget cash flow expert. But I'm just giving you a bit of a heads up on some of the things that you might include in budgets and cash flow forecasts. The next item we wanted to look at was understanding forecasting. And we have calculators to help calculate charge-out rates for trades businesses, to calculate an appropriate retail price calculator based on a various mix and professional fees calculators. And in a later webinar, we're going to try to introduce one at a time some comment on these calculators so that you as a director get an idea of what is available in the marketplace, especially if your organisation's got no proper basis for determining what a charge-out rate for a tradie will be. If it's just copying what the competitors are doing, that's not very smart. Now, on smartness, I now want to introduce you to a man who is smart. Paul Barnaby is a chartered accountant and the regional consultant for Plan Guru, and he's going to talk to you about good budgeting helps businesses operate efficiently. So how are you, Paul?
I am really well, thanks very much, Peter. So thanks very much for that introduction, Peter, and welcome to my segment today on how to prepare proper three-way budgets in under 60 minutes. And while that might sound like a bold statement, yes, it definitely is possible. So just a little bit about me before we really get into the meat of it. As Peter said, I'm a chartered accountant. For a good number of years, I was managing partner in a second-tier firm in Wellington, New Zealand. And before you get going on the Bledisloe Cup jokes, I do have dual heritage, so I get a bob each way. During the time that I was in that general practice, I developed what has become a passion, but actually a 20-year specialty in what I call predictive accounting. And predictive accounting is nothing more or less than doing in the future what we already do for our historic accounting. So it's the same thing. Of course, it embodies financial analysis and strategic planning. So that's part of the briefs that I have. And of course, budgeting and forecasting, including cash flow. So my consulting practice that I have is styled Beyond Accounting Technologies. And as Peter said, I'm also the regional integration consultant for Asia Pacific for Plan Guru. And Plan Guru is a firm based in the US that provides tools for this actual process. And although they're based in the US, Plan Guru is used in around 50 countries right around the world. So I personally have consulted to, supported, helped and trained many hundreds of CFOs, accountants, business managers in this area. And I see my role as helping accountants and CFOs look like superstars. So just what I want to talk about a little bit today is the need for strategic plans and budgets. Because I know Peter's topic is corporate governance, but this is an essential part of corporate, good corporate management. And there's an old saying that goes, if you fail to plan, you plan to fail. Now that's a pretty old saying, but it's just as true today as it was when it was first invented all those years ago. Because it's an absolute fact that businesses who have a plan will be more successful than those who don't. I speak with a lot of businesses in the course of my work, and I ask them, how do you plan to grow your business? Are you planning to grow it? And they often say, yes, we're going to grow organically. Well, all that means is that it's going to grow like a plant out of the ground. But unless you have a plan, like water, then the plant's not going to grow. Because if you set financial targets and then measure the actual result against those targets, you will be more focused on the strategies that contribute to success. On the other side of it, if you don't have the targets, your strategic ideas will be a bit more hit and miss. So again, I see my role as helping you or your company or your client operate like the big corporates, all of whom do this. And the way I will do that, or can do that, is to help you implement these time-tested methods by preparing your three-way budgets and forecasts, and that's where my help comes in. So, you need a budget. What do? You reach for Excel, right? Wrong. Excel is a great tool, but it was never ever built with budgeting in mind. Spreadsheets are great. I have used them for many, many years, but Excel was designed for not only accountants, but engineers, chemists, designers, you name it, everybody that can get their mind around formulas, but not built for budgeting. And if you are saying, well, so what? Have a look at this. There's a fellow at the University of Hawaii called Ray Penko, and he's published not one but two international research papers into spreadsheets, Excel files, etc. And he's discovered that 88% of all the published spreadsheets that he analysed had errors that the authors did not know about. I repeat, did not know about. And so there's all these spreadsheets out there that have got mistakes in them and people don't know. But if that doesn't frighten you enough, think about this. Excel budgets, to do what I'm going to show you today, take 10 times as long to prepare as by using a purpose-built tool. So why would you bother? There are a choice of applications out there, and all I can suggest is that you choose the best that suits you and your situation, and are the best for technical and cost reasons. As I said before, I'm the regional integration consultant for Plan Guru. That is my selection, and with the years that I've had in this business, I know what works and what doesn't work, and Plan Guru works. So what are the key aspects of a successful budget? Firstly, they must be three-way. Just having a sales forecast or profit and loss on its own is not enough. You've got to do balance sheet as well, and if you do profit and loss and balance sheet, you'll have associated cash flow. You must start with known data. In other words, the historic results, your latest financial published accounts. And a successful budget has to be driver-based. When I first learned budgeting, we just used last year plus or minus a bit. That's not budgeting, that's guessing. You've got to look at what drives the business. Is it the number of products that you sell? Is it the price that you sell them at? Is it the number of customers that you've got? Is it the terms you give your customers? Is it the investment you've got in R&D or fixed assets? Is it the terms you get from your own suppliers? Those are all what I call drivers. You must also be allowed to look at budget, actual, and forecast, because those are three different types of data. And obviously, variance reporting is a must. You must be able to compare what you budgeted using those drivers that I mentioned and the actual that comes through your accounting system. And other reporting has to be flexible and able to be configured to produce reports that you want, not what the software provider wants you to have, but what you want. So let's go and have a look at a budget. I've already got one prepared, and I'll just go and open that now. And the model that I've got is a computer reseller. And I've got a budget opened there, and you can see that they sell computers, hardware, printers, software, and accessories. If I scroll a little bit across to the right, you'll see that I've got the results by groups of products, and I can total those up if I want to just look at the group totals or look at the individual lines, and you can see they've got a budgeted revenue of around 3.5 million. How have I done those sales lines? I've used the drivers. I've used quantity. So there is a table of the quantities that I've used, 147 units a month in low months and 293 in the high months. And then I've linked that to the line in the revenue statement by just putting in a price, in this case, of $500. Okay, so that's the way I've had the driver for the units sales. Cost of sales I've done on percentage. You'll see there are the operating expenses, and we're looking at a net profit before tax of around 300,000 for this company. Here is my balance sheet budget, and you can see I've also got that month by month, and because I've got profit and loss and balance sheet, I also get cash flow. So here comes the cash flow report, and I won't bore you with the details of it, but you'll see there it starts from operating revenues and works through to operating cash result, looks at things like investment and financing to give you an end cash result. So you can see here I'm forecasting a surplus in August of just over 3,000, in September of 67,000, and then a larger surplus going on further. I mentioned we must be able to do variance reports. There is a variance report for December and year to date. So I've got budget, actual, dollars and dollar variance for December, as well as percentage, and then year to date I've got budget, actual and variance. If you really want to get smart with your reporting, Plan Guru comes with an advanced reporting add-in, which I'm showing you here now, and I've actually done a budget versus actual versus forecast report there. Same data, just pulled out in a different way, and then comparing the actual result that we attained against the original budget and the revised budget or forecast. And then I've got a variance budget to actual and a variance forecast to actual. Plan Guru also comes with a cloud-based reporting tool called Plan Guru Analytics, and I'll just show you that here. And this is a method by which you can share the output of your budgeting system with your company directors, colleagues, or whoever. Anybody with a smart device can log in securely and have a look at these reports. I've got a dashboard there. You can have a scorecard as well, or you can have quick reports. So, Peter, there in about a 10-minute nutshell, I've given you my thoughts on the process of budgeting, profit and loss, balance sheet, and cash flow. So I'll now hand back to you.
Yes, Paul, thanks very much. That was very interesting. And in the subsequent presentations that you're going to make in Corporate Governance Network, you'll be able to take people through this process in a bit more detail, won't you?
I will indeed. I'll show the whole process of developing a budget from scratch to the level of detail that I've shown you here this afternoon.
Yeah, just do you or Plain Guru actually conduct like a training session for company directors as who might not want to actually prepare budgets, but would like to understand the process in a bit more detail?
Absolutely, we'd be very happy to do so.
Okay, that's interesting. So for the participants, the people who are subscribing to this series, can you please bear that in mind if you do need some mentoring on the actual budget cash flow preparation process that your accountant might be doing, but as a director you need to understand that because ultimately you're the person that's responsible for it. Paul's able to give you some training courses on that so you understand how this process works. Thank you very much, Paul. That was very interesting. Just to summarise, Paul talked about three-way budgeting process. I think that's very important. I personally have done that for years. So we have a P&L budget, a projected balance sheet, and the cash flow that flows from there. It's very important that you anchor it back to the historical results and then use projected information, which Paul called driver-based, not just take last year's figures plus 10%. And the variance reporting is very important. And obviously the training program that Paul can offer to company directors and committee members so you have a better understanding of the process relative to budgeting. Let's move on. Marketplace overview. Just to give you a slightly different look on life as a director. What's happening in your markets, local, state, Australia, or international? Directors should be conscious of this and you should be getting told. Or if you're in a committee and you're doing various things, what's happening? What's going on with new competitors, new products, new technologies, customer comments? Are you as a director or committee member being privy to this sort of information? Focus groups for new products and services. Focus groups can be very beneficial, but are the reports coming back to the board? Do you know what the focus groups said? And do you know what your customers want? As a director, if you're not receiving this information, my suggestion is that you should be asking for it and saying, we need to know this. Because one of my fears would be that if you're not getting told this sort of information, perhaps your management team's not looking at it. Let's move on now to what goes into a marketing plan. An interesting question. Why does your company or organisation exist? What's it want to achieve? Is there a marketing plan? What were the strategies for this year? How are you going to inform your market of what you're doing? Is it the website, social media, news releases? The two that you've really got some control over there are your website and social media. Both activities really didn't exist 10 years ago for businesses to use. Are you conducting planned events? Utilizing digital marketing strategies? Newsletters? Is there regular communication with your customers, your patients, your members, whether you're a company or an organisation? And who is responsible for marketing in your organisation? Are you as a director receiving a report? This slide is probably directed at organisations, customers, patients, members' needs, or it's someone in the medical area. Who's your target service? Are you supplying those key targets? What are you going to do about it? Do you have other services that you could also provide? Do you clearly articulate your value proposition? Now, I'm using the word "your" right through there. This is the management team, but you're a director. Are you asking these questions? Or have you been isolated from all this? I think you're entitled and should be asking the questions. The courts are widening the ongoing responsibilities of directors. They're not narrowing them. They're saying directors have got to have their finger on what's happening in the organisation. So let's look at customer needs. What are they? I think you need to have an understanding of what your customers need. Do you know who your customers are? I've talked to some directors and I think they were rather vague as to who their business's customers were. What do they purchase from you? What do they buy from you? Do you have other products or services that your company or organisation's producing that you could probably sell to them, possibly sell to them? Allied selling, companion selling. Do you want fries, sir? It's become famous as part of jargon now for selling that was customised by McDonald's, and that might have started at the board by someone saying, are our cash register staff trying to value add? Why don't you buy these other products or services from us? Could be a question. Who's responsible on business-to-business selling? And are you emphasising the products and services and what they will do for your end customer? Have you made it easy for the decision maker to review your proposal? Or is it full of jargon and 100 pages? They probably won't read it. Have you got webinar displays on your website that someone could just click through in a couple of minutes, get a better idea of what you do? Are you articulating your value proposition? We're going to talk more about competitors in the next few webinars, but today I'm starting with the first part of a competitor analysis. This is part of strengths, weaknesses and opportunities and threats, a SWOT analysis. Why don't you start looking at this and bring it back to the next workshop webinar where you analyse the strengths, your companies, and then you can identify 3 competitors. And obviously if you want to make it 10 competitors, please do so. What's your business strengths, and then how do your competitors line up? Products and services, how do you line up against the others? Core competencies, most profitable aspect of your business. Now you might be guessing on your competitors, but that's all right. And what is being done well? What do you do that you think you're doing well, but what do your competitors do? And we're going to be asking you to have a very good look at this in future webinars. So next week or next webinar, we're going to be looking at weaknesses. Same sort of format, your company and 3 competitors. But if you want to make it 33 competitors, be my guest. I now want to move on to our final keynote presenter today. I've known this gentleman for about 7 or 8 years. I heard him speak at an accountants conference and he was talking about selling. That's not the normal thing you get at an accountants conference, I can assure you. Someone standing up and talking about sales. So Trevor Marchant, who's a former sales training manager for Westpac back in the 80s, he's going to talk to us today about every business needs to make sales.
Hello there. Trevor Marchant's my name. I'm the Managing Director of Marchant Dallas Consulting. Marchant Dallas Consulting is a consulting company that was set up probably close to 20 years ago now to work with accounting firms and their clients, always looking at ways and means to do some business development with them. Peter's asked me to talk to you today a little bit about sales and marketing, which is sort of one of the things we do, and I guess it's probably the primary thing that we do. Why me? Well, I used to be the head of training, education and development for Westpac many years ago. I'm an accredited master sales trainer out of the Dale Carnegie organisation in Greenville in South Carolina. I've been featured in the top 1% of sales and marketing coaches in Australia and New Zealand on a couple of occasions. A little over 5,000 business owners have been through our programs. We sort of stopped counting at 5,000. And we've dealt with about 70 accounting firms up and down, largely up and down the east coast of Australia. I've run well over 1,000 workshops on a range of topics, primarily around that business development area. And we have a number of publications in the marketplace around sales and marketing. Just so you get some sense of the sorts of people we deal with, here are some of the graduates of our programs. This is not an up-to-date list, but it'll give you some broad idea of the sorts of folks that we've been dealing with over the last 20 years. Pretty much most of the professional services areas, engineering, manufacturing, farming, not so much farmers, but more to the point, people who are supporting the farming community, although we have had a couple of farmers, apple growers and people like that. Most of the trades we've dealt with through these programs, pretty much most of the retail folks, some franchise systems, some IT people, pretty much all the food areas. And more lately, I think there's a lot more health people coming into our business. As you can see, we've got doctors and dentists and optometrists coming through and looking at ways to grow their business and to improve their marketing and sales, that business development area. The point about all of this is it really is just a matter of applying some ideas, and it doesn't seem to matter what sort of business you're in, what sort of industry you're in, what your turnover is. The things that we teach just work. As a structure, from a business development point of view, we tend to follow this structure. It's about the marketing of your business, and if we don't market that well enough, then you don't get that opportunity to sit down in front of a client and talk about what you have to offer. It's about the selling process. As you know, nothing happens till something is sold, and my experience is that most people, most SMEs particularly, have never received any really quality sales training. It's about delivering, promising delivering what you promise, and then servicing. And the emphasis for us often is on the servicing aspect. That is, after the sale has been made and the customer or the client's got your product or service, they've paid you some money. What are we doing about continuing working with those folks? Because if we get the servicing right, it just takes the heat off the front end, off the marketing, because you start to get referrals and word of mouth things start to pop out. But as a structure, that's the process that we work through. As mentioned, nothing happens until something is sold. Now, selling, from my point of view, I'm very biased in this area, but without sales, our entire society would come to a grinding halt. The only real creators of wealth in our society, as you know, are businesses. Businesses produce all the products and all the services. They create all the profits and all the wealth. Businesses pay all the salaries and all the benefits. The health of the business community in any city, state, nation is the key determinant of the quality of life and standard of living of the people in that geographical area. Strong statement, I believe it to be true. Salespeople are the most vital people in any business. Without sales, the biggest and most sophisticated companies simply shut down. Now, you don't have to have the word salesperson on your business card. The fact is, if you're a business owner, you're in sales. In fact, most folks that work in a business are in sales in one form or another. They're either direct selling to the market, or they're supporting somebody who is selling to the market. And as I say there, sales, in my view, is the spark plug in the engine of free enterprise. Without sales, nothing happens. Philosophically, every business is two businesses. There's the one that does the work, and there's the one that sells the work. My experience is that you get a lot of folks that can make what they sell, but they often can't sell what they make. Hence, there's an opportunity there, I guess, for organisations like ours to work with these folks, teaching them how to market and sell their business better, and hence in a process, an overall process, developing their business further. And if we can't sell, well, it's lights out. And we see a lot of those things happen. We see businesses, unfortunately, fail, but I think probably businesses don't really fail. I think people just give up, and they give up for a variety of reasons. Peter's asked me to give you a bit of a crash course in selling, so here we go. The sale is defined by the client. I don't believe that as a salesperson you actually make a sale. The client makes the sale. What we tend to do is create a set of circumstances in which a sale can take place. Our job as a master salesperson, if we like to call ourselves that, is to create an environment where people want to buy. People don't like to be sold, as you know, but they love to buy, so let's give them an opportunity to buy. Question for you, and I don't want to answer the question necessarily, but do people buy what they want, or do they buy what they need? Knowing full well that there are some things out there we would argue that we need, My position is probably, though, that most purchases are based on want. They're based on an emotional side of us, and then later on we might tend to defend that emotion with some logic. My definition of selling is simply getting someone to do something they would not otherwise have done. If they would otherwise have done it, then they really don't need us. So it's essentially, finding out what people want and why, and then talking to them about how you and your company can help them get it. Selling is giving. It's about giving time, attention, counsel, education, empathy, leadership and value. The word sell comes from an old English word, selan, which means, you guessed it, to give. So think about selling in a new light. Don't see it as some of the things that you've heard about in the past. In every industry, every profession, there's an element of we don't want to go there. But selling actually is a good thing. It's a noble thing to be doing. And think about it from the point of view of sharing, leadership, counsel, and giving. One of the greatest salesmen ever, Nelson Mandela, the late Nelson Mandela. If you think about that, I mean, this is a guy that was incarcerated for 27 years, thereabouts. No regrets, then came out of that situation and turned a country around, turned it on its head and became the president. I mean, what a sale. And you think about this, where he came from and what he did, it was about talking to people, finding out what they want, why they want it, and then talking to them about how he could help them get it. Magnificent. Probably one of my top salesmen ever. Now, in sales, if they like you and they believe you and they trust you and they have confidence in you, then they may buy from you. Think about that. There's a lot of things in there. They've got to like you, they believe in you, and they trust you, and they have confidence in you. Well, they may buy. So a lot of things we need to work on a personal level. People buy why you do things, not what you do. In other words, they buy what you believe in. What you do is the proof of why you do it. If all I did was buy what you do, then my choice is quite extraordinary. I can walk up and down Main Street or surf the internet, and there's lots and lots of providers in that same field. But what I really want to tap into as a buyer is why you do it. I want to tap into your passion, into your belief. That's why when we talk about setting up a business, probably we start with why. You've heard that talk before, but it's all about purpose, why you do it. It's not so much what you do, it's why you do it. So what's your purpose in selling? That's a good question. Here's my purpose in selling. To add value to people's lives by showing them or giving them a practical, workable solution to bridge the gap between what they have and what they want. Now, if you think about that, I can take that attitude anywhere in the world and speak to any person, because it's not about selling products or services. It's simply about finding out what these folks want and why, and see if what I'm offering can help bridge that gap. It just makes a difference. It's what I call a noble purpose, and therefore it helps. It takes away all the fear, gives you a lot of confidence in terms of anybody that you sit down with, because what you're really trying to figure out is where the gaps are. And will your product or service fill those gaps? If it doesn't, we move on. We may be able to suggest something to the client. But that's essentially what it's about. So whenever you sit down in front of a person in a sales interview, it's not about selling a product or service. It's about finding out what they want and why they want it, and then seeing if your product or service can provide a solution to that. My 12.5 principles of selling, part of my crash course, always start with why, and we've talked a little bit about that. Start with why. Why provides the motivation. We need to get our attitudes right. Attitude comes across as a form of energy. If you don't like what you're doing, and if that's what you're doing in a sales role, then you need to get out of it, because potential clients, potential customers will pick that up. So we have to get the attitude right. It's the glass half full attitude that we need to take forward. We need to manage procrastination. Sales folks can put a lot of things off. People talk about time management. To me, it's not so much time management. It's managing energy and managing procrastination. So we need some lessons in time management. In my opinion, are a waste of time. You know what to do. You know when you have to do it. We need lessons in procrastination. Why are we putting this off? Lessons in confidence, self-image, purpose, lessons in fear of rejection. You know, it's okay. We're not going to please everybody that we meet. Lessons in preparations, lessons in dealing with the things you don't think you have time for, but in reality that we're just avoiding. So we need to manage our procrastination. We all get sidetracked too quickly. We need to be prepared for any sales situation. There's no point going into any sales situation and thinking you can wing it, because you can't. We need to find out a little bit about the person coming in to see us, or the person we're going to see, and get some sort of thought in mind as we progress. And of course, this whole notion of value, people say, you know, it's a question of price or a question of value. We need to learn how to sell value. I think what we need to understand here is that you are the value. Value is not something you add at the end. Value is something that you start at the beginning. The mere fact that you're sitting in front of a potential client or a potential customer, that is a prospect, is that you're already bringing value to the table. Think about your experience, think about your training, think about all of those sorts of things. So value starts right at the front and works right through. I'm not a big fan of this adding value at the end. It's just a wrong thinking altogether. Number 6, stop selling sugar and learn to speak prospect. What I really mean by that is we can get into this habit of thinking everything's a commodity, everything's a product. We need to understand a little bit more about the client and start talking in their language. For example, if they're an engineer or a pharmacist or an electrician or a painter, we need to do a little bit of work and see what sort of words and thinking they go through. You know, who's your ideal customer? What are the challenges that these folks tend to face? You know, who's the competition? What are their strengths? Who are you, like personally, in terms of this sales situation? And, you know, what do your clients really like about you? 7, in my 12.5 principles, it's about the relationships. As you know, selling is not so much about the sale, it's about relationships, building relationships with people. Find out what people want and why, and then show them how you can help them get it. Ask questions. If you want great answers, you've got to ask great questions. Listen. You know, we have 2 ears and 1 mouth, and that's probably the proportion in which we should go into any selling situation. In terms of the time involved. Ask questions and listen to what people have to say. Summarize what they're saying, develop a plan, get agreement, trial close, you know, based on what we've covered so far, how does it sound, that type of thing. List the action steps, who, what, how, when and why, and implement the plan and then measure it. But that's basically a process that you can follow. We need to understand their motives. Why do they buy and why don't they buy? Well, people generally don't buy for those 4 reasons there. No need, no hurry, no money, and no trust. The first 3 can come up as objections. Sounds good, but right now I just don't feel like I need to do this. I've got some other priorities. And so it goes on. And they may be genuine, they may not be genuine. And there are ways in which you can test to see if they are in fact genuine. The no trust one, though, is captain of the team. If there's no trust in this situation, nobody's going to buy. They need to trust you, they need to like you, they need to respect you. They do buy because they like you, they trust you, they believe in you, they have confidence in you, they perceive value in your product, the price seems fair, they understand what they're buying, and people believe that the product will help them solve a problem. So that's essentially what we're selling, aren't we? If you look at it, we're looking at finding solutions to the issues that these folks are facing. And often it's not just the solution, it's the feelings that are associated with those solutions. Think about that for a moment. That's really what we're selling. If I've got a solution to my problem, how does that make me feel? Because that's really what you're selling. As part of your go forward, I encourage you to set your goals in selling in all areas of your life. We have a purpose of selling, which is your noble purpose, and that gets you in front of people. But we also need to have some goals in selling. You know, why are you doing it? Why are you in this business in the first place? I encourage you to set some goals in those areas, in your health, wealth, self, relationships, and time. If in fact you can set a goal or 2 in each of those areas, then you can use your career in selling or your business to drive those goals, to be the fuel for achieving some of those goals. Because at the end of the day, those 5 areas are really what count. There are laws in selling. In fact, there are a number of laws. Here are some basic ones. The first law is that we all want to be happy. So think about that. You want to be happy, and so does your client. But happiness is relative. What makes one person happy doesn't necessarily make the next person happy. The third law is resources are limited. Just because you think this is a good deal doesn't mean that your client or your prospect thinks it's a good deal. So this is where we need to ask a lot of questions. And the fourth law in this process that I'm talking about, there must be a profit in any exchange that involves handing over money for goods or services. And we must be convinced the product is a quality product, that it's worth the money we're paying, and it'll do something for us that we want done. For example, if you've got a motor vehicle that you're selling for, let's say, $10,000, and you're selling it to Rosemary, and Rosemary's got the $10,000, Rosemary needs to believe that the car that she's buying is worth more than the $10,000 she's got in her pocket. And you need to believe that the $10,000 is worth more than the car that you've got to sell. So there has to be that profit exchange. If there's not, then someone's losing, and there will be some grief that will follow. Point number 11 is what I call the myth busters. Over enthusiasm in selling is not necessarily a virtue. Certainly passion is. I think the love of your product, the love of your company. But I guess the last thing that I want in front of me is an enthusiastic salesperson. Sales success is not about convincing people to buy what they don't want. So we need to get rid of that. It's about asking questions. It's about finding out what people want and why, and then talking to them and moving forward on that. You don't have to answer every objection. In fact, if you're in selling, you want objections, because people don't raise objections, they're not listening. All an objection is a question. It's a question about value. It's a question about timing. It's a question about, do I really need to move on this product? Quiet people will outsell noisy people all day long. In other words, you don't have to reinvent your personality here. You don't have to be this smooth-talking, animated, loud, noisy person to be good in selling. I've managed many sales teams over many, many years, and I can tell you now, it's the ones that just take it easy, step by step, that outsell everybody else. Don't need to be a smooth talker. Don't have to motivate people to buy. In fact, you can't motivate anybody unless you're doing something externally to them. The thing is, we create a situation, a set of circumstances where people want to buy. As I say, you don't have to reinvent your personality. Number 12, ask for the business. Always be asking. So through the sales process, take the time from time to use what I call some trial closes and see how the sales process is progressing. But we need to be always asking for the business. The worst thing you can do is go through, ask questions, present a solution, and then not ask for the business, particularly if in your heart and in your mind you think what you're offering is of good value and will actually do something that the client wants done. So don't be afraid to ask for the business if in fact you believe it's a good thing for the client. I think called the sales paradox. When I stop trying to get what I want and start helping other people get what they want, I actually start getting what I want. Think about that. The way moving forward in selling is, to find enough people to talk to. And the more you can find people to talk to, help them get what they want, in fact, you will then start to get what you want. So if you're looking to take this a little step further, there are some next steps, and Peter can help you with that. There is a program that we run. We've been doing this program for many years now. Several thousand of people have been through it. This particular one has 12 modules in it, and we're finding more and more that people prefer to do the program this way because it's self-pacing, can be done at home, can be done in teams, and it works. And I get involved in that process, so I personalize it with you. For more information, there's the information, and thank you for taking the time for listening to this, and thanks again for Peter to inviting me to talk to you. Cheers.
Thank you very much, Trevor. That was an interesting summary on selling, wasn't it? Looking at the 12.5 principles of professional selling. And the key final message, of course, is ask for the business. On the ESS Small Business website, we have some products prepared by Trevor Marchant's company, the Sales Factor. You can go onto the website and have a look at them, and they're the prices that I've got on the screen. I did have a summary for the Export Market Development Grant for today. Unfortunately, running over time a little bit, but the Export Market Development Grant is a grant for exporters of products or services from Australia, but it can apply to an Australian-based business that is bringing overseas visitors to Australia. You might be in the hotel or tourist businesses catering for overseas visitors. Does not include export of goods or services to New Zealand. The New Zealanders love this, being linked with North Korea. New Zealand is obviously very close and treated as really as part of Greater Australia, while North Korea, well, I don't have to comment on that. Hopefully they're going to change a few attitudes over there, and maybe they'll be admitted to the list in the next couple of years. The maximum grant you can receive is $150,000, and it applies to businesses, any type of businesses, not just companies, with turnovers under $50 million. The reimbursement's on a 50% basis, and it has various categories. There's 13 categories: overseas market visits, overseas representation, free product samples, trade fairs and literature, engagement of marketing consultants, bringing overseas buyers to Australia. So you can see there's a wide range of items that can be claimed under this grant. Promotional literature and registration or insurance of intellectual property. So that's what can be covered. Applications have to be submitted to Austrade by the 30th of November 2018. And within the members area, we've uploaded a paper that we have written on export market development grants, so you can read it. If after you've read that you have any questions, please don't hesitate to contact us. Also on ESS Small Business, there's an overview of the ESS Grants Identifier. If you would like to find out what grants might apply to your business, you can fill in the business profile form and forward that to us together with your fee payment of $199, and we will produce a report for you on the grants that you can potentially apply for. If you wish us to handle the grant applications, we will submit you a separate proposal relative to that. The action plan that you now have to look at is completing your action plan for this month based on this webinar workshop today. In the members area, you have a complete action plan template that's been produced with every item that we've discussed in this webinar recorded on it. Please sit down and look at the actions that might relate to your business or to you personally on the actions that you would like to implement. I just want to acknowledge the keynote speakers that we have in the Corporate Governance Network series. They're very important for us. Ross Condorino from the AI Group, Paul Barnaby from Plan Guru, David Birch, Smart AR and FeeLink, Jordan Lowry from Blackstone Business Group, Trevor Marchant from Marchant Dallas, Andrew Geddes from Andrew Geddes Proprietary Limited, and yours truly. If you want more information, and some of you are watching this webinar recording for the first time, you can click on to www.esssmallbusiness.com.au and then go onto the Corporate Governance Network, and you will be able to read the Learn More and understand the full program. Or you can send me an email, peter@essbiztools.com.au. Telephone calls are also most welcome, 1-800-232-088. Thank you for your interest in the Corporate Governance Network by your participation in this webinar workshop. Once again, thank you to the keynote speakers, Andrew Geddes, Ross Contarino, Paul Barnaby and Trevor Marchant. Thanks for your interest. Have a wonderful day. Goodbye.